Hello, great hosts. I hope exam prep is going well. Today we're looking at the September 2024 accounting paper 1, and it was written in the Eastern Cape province. So we'll just specifically be looking at question 2, which is financial indicators and the cash flow statement. So the question was allocated 40 marks to be completed in 30 minutes. Now, the information relates to Shaba Ltd for the financial year ended 30 April 2024. So in this case, we know our year began on the 1st of March, 20 on the 1st of May, sorry. Since that's the 1st of May 2023. So we are required to calculate the following financial indicators for the financial year ended 30 April 2024. Okay, but just before we begin, I suggest that you watch the video where I was explaining financial indicators and the formulas that we use when we are required to calculate financial indicators so that you are familiar and you can be able to watch this video without any stress on how to use the formulas. Okay, so the first one is a debt equity ratio. So we know here that we're looking at our non-current liabilities. So as the name suggests, debt is our non-current liabilities, and we're looking at our equity. Okay, so looking at our equity and our non-current liabilities. So when we calculate this one, we are going to look at our non-current liabilities. Just like I've said, we have non-current liabilities of 1,294,000, and our shareholders' equity that we have in this case this year is 12,624,400. Okay, so we are going to have 1,294,000 is to the 12,624,400. Okay, so this is our equity. Oh, this is our equity, and then this is our non-current liabilities. Okay, and then what we're going to quickly do, we're just going to say 1,294,000 divided by 12,624,400, which then gives us 0.1. Then here we're going to have 1. So our ratio is 0.1 is to 1. Okay, so that's the debt equity ratio. Simple. We're looking at our non-current liabilities as to our equity. So it's debt to equity. The second one we are required to calculate is our earnings per share. So our earnings per share, we know that it is the net profit before tax. Okay, so it is the net profit after tax rather, sorry. So it's net profit after tax divided by the number of shares in issue at the end. Okay, and then you can just simply multiply by 100 if you want to write your answer in terms of cents. So what we need to determine is our net profit after tax, and we need to also determine the number of shares at the end. Okay, so let's determine our net profit after tax first. So looking at the information that we were given on information A, it says the extract from the statement of comprehensive income on the 30th of April 2024. So we're given depreciation, interest expense, and the net profit after tax of 1,022,000. Okay, so we are just given our net profit after tax here, which is exactly what we're looking for. Okay, so that's 1,022,000. We know we have 122. Okay, then now we need to determine the number of shares that were in issue at the end. Okay, so that information is given on information E, which is the share capital and shares, in conjunction with information F, which is the dividends and the earnings per share. So the share capital in shares, the first bullet point says there were 1,340,000 shares in issue on the 30th of April 2023. So this would have been the start of the year. And then additional shares were issued on the 1st of November 2023. Okay, so we're not told how many shares, we're just being told that additional shares were issued on the 1st of November 2023. And then we had interim dividends being paid on the 31st of August 2023. So be careful with these two events. We know that this one happened first, And this one came right after, just that they listed them in a different order. So the last bullet point says on the 30th of April 2024, shares were repurchased. The value of the shares as per the average issue price. Okay, the average issue price, we know that that is linked to the ordinary share capital. Okay, is okay, it amounted to 28,000. So the 28,000 is what we would have recorded on the ordinary share capital, because that is what we record when we repurchase shares. Okay, but now remember that the premium or the extra amount that is being paid when we are repurchasing shares, it goes to our retained income. So here they then continue to say that the asking price was 15% more than the average issue price. So if it was 15%, we know that the 15% goes to our retained income. Okay, so now when we look at information F says dividends and earnings per share, because information E doesn't really have anything so far to help us with determining the number of shares at the end, because we're not necessarily given all the figures that we need to complete our ordinary share capital note in case we wanted to. Okay, so when we look at information F, to save ourselves some time, we are going to look at the final dividends per share. We know that 25 cents was declared for the final dividend. The number of shares at the end will receive 25 cents per share. But now we do know that this amount that was paid or should be paid out to the number of shares at the end is 188,000. So we can use these two figures to determine the number of shares at the end. So now what we can use is this number of 188,000 and say the 188,000 is what we're supposed to pay to the number of shares at the end, multiplied by the 25 cents that we have paid for each of those shares. So it's 188 in this case, and we'll divide by the 0.25, which will give us 752,000 shares at the end. Okay, so we know that here we have the 752, and then we'll multiply it by 100, and then that gives let's see, so that's 1,752,000, and then that is 135.90 cents. So that's 135.9 cents. Okay, so now we need to determine the dividend payout rate. So the dividend payout rate is how much we have paid to our shareholders from the earnings per share. So we know that the earnings per share was 135.90. That is what each share has earned. And now we have paid to our shareholders 20 cents and 25 cents, right? So that becomes 20 plus 25 cents, and then we'll multiply that by 100. And then we're going to say 20 plus 25, okay, over the 135.9, and then that gives 33.11%, and then just say 33.1. Okay, and then we are going to look at the percentage return on average equity, which is our share. So the percentage average on average, percentage return on average equity, you know, as soon as they say average, you need to find either the midpoint between two things, which is in this case our net profit after tax, and then we need to find the half of our opening balance plus our closing balance. Okay, then we'll multiply it by 100. So this is our shareholders equity. Okay, so that's our shareholders equity. Now let's look at the information so that we can be able to work this out. Okay, so as we have determined earlier, we said our shareholders equity is 12,624,000. That's our opening balance. That's our closing balance rather. And then our opening balance was 9,319,200. So we've got the two numbers that we need. So we're going to have our net profit after tax that we have determined as 122,000 over the half of 12,624,100 plus, let's just check what the other one is. And then, okay, this is 400. It's 12. Let's just make sure it's 12,624, 400. Okay, we've got it. 624, 400. And then let's look at this one more time, which is 9,319, 200. Okay, so it's 9,319, 200. We'll multiply that by 100. And then let's quickly punch into the calculator. So that's 1/2 12,624, 400 plus 9,319, 200 multiplied by 100. And then our average return on equity is 9.31, which is 9.31%. Okay, and then now we're going to quickly move on to our retained income note. Now, as you might have seen in the previous videos, what I usually do at first is just quickly populate the retained income note with the things that I want to calculate. So we know that the first thing here that we will have is our repurchase of shares. Okay, and here I have my interim, and here I have the final dividend. Okay, as soon as we can, you can just literally fill in what you already know. We know that the final dividend was 188 because we are working with it just now to calculate our shareholders equity. And then with the interim dividend, we need to determine that, but we'll just look at that now. Let's look at our repurchase of shares. Okay, so the repurchase of shares, we did mention that we had 28,000 as our average issue price. Okay, and then the asking price was 15% more. We know that the 15% goes to our retained income. So basically the shares were repurchased at 115% of the 28,000. Okay, and then that would be times 115% times 28,000, that would be 32,200. Okay, so which means we repurchased the shares at 32,200, and we can simply just determine the 15% from there. So it's 15% times the 32,200, or what is correct actually is the 32,200 minus the 28,000. So that would be correct, not the answer I've just mentioned. Okay, so there's 32,200 minus 28,000, which gives 4,200. Okay, so we're going to have 32,200 minus 28,000, and then that is 4,200, which is a decrease in our repurchase of shares. And then when we quickly look at our interim dividend, we know that we have paid 20 cents. Okay, we've paid 20 cents, and we paid this on the 31st of August, which is before the additional shares were issued and before the repurchase of shares. So we're going to use the 1,340,000 shares that were in issue at the start of the year. Okay, so we're going to take the 20 cents multiplied by 1,340,000, and let's see what that gives. So that is 268. Okay, that is 268,000. Right. So now we are going to simply sum up the 188 plus the 268. So that's 188 plus 268, which is 536,000. Okay, so let me just ensure that my calculation is correct. 268, 188,000. Okay, so I might have added something a bit extra. That should have been 456,000. Okay, so that's a bracket there. And then now what we are looking at, we are going to determine the balance on the 30th of April 2024. So that's 300 plus the 122 million. Okay, that's 22 minus 4,200 minus 456. and then that should give 1,862,100. Okay, then that is our retained income note, and 2.3 were required to calculate the change in trade and other receivables. Okay, so we are given note 1, which is our trade and other receivables, and we were given the balances on the 30th of April 2024 and 30 April 2023. So our net trade debtors was 528, and we have 426,800 at 30 April 2023. Okay, so here we have 528. Okay, but we know that what we need to determine is our total change in the trade and other receivables, but we're not going to look at our SARS income tax in this case because we account for that in our taxation paid. Okay, so when we look at our net trade debtors, we know that we had accrued income of 30,800 and the net trade debtors of 528 for this year. And then last year we had 426,800 worth of net trade debtors. Okay, so we're going to add the 528 for this year. We have the 528 plus the 30,800. Then we're going to subtract the 426, the 426,800 also. Okay, now we can definitely see that we have an increase in our trade and other receivables, which means this is going to be an outflow because we haven't really been receiving any money, but we've just been giving let's say maybe we've been selling stock on credit, and that's an outflow. So it's 528 plus 30,800 minus the 426,800, then that's a change of 132,000. Okay, so that's 132, and you need to show that this is an outflow because we're working with the statement of cash flows. And then with the taxation paid, our starting point should be information B, where we are told that taxation is 30% of pre-tax profit. So pre-tax profit is just a fancy way of saying net profit before tax. Okay, I don't know why they use pre-tax profit. Never heard of that, but nonetheless, it's the same concept. It's net profit before tax. Okay, so in that case, we need to determine the current year's tax expense. Okay, so we know that our net profit after tax was 1,022,000 multiplied by what we want, which is 30%, and what we know is that this is 70% because our net profit before tax is 100 minus tax, which is 30%, and then we are getting 70%. So in this case, we know that this is 70%, what we want over what we know, and then let's quickly calculate what our tax is. Okay, over 70. Now our tax should be 438. Okay, now we know that taxation paid is always an outflow, so we're just going to work with positive numbers, and then at the end we are going to indicate that it is an outflow. Okay, so we know that this is 438,000, right? But when we look at our net, when we look at our trade and other receivables, we know that we were supposed to receive 32,600 as a refund from SARS, right? So we are not going to pay that. It is not going to result in an outflow. So therefore, this will reduce our taxation paid by 32,600. Then now, our current year's balance of 9,900, we are supposed to receive this amount. So this simply means that we have overpaid SARS such that it is now a receivable. We have overpaid SARS. This tax is overpaid. Okay, so now since it is overpaid, we are going to say it is a cash outflow. So we're going to add it on our cash outflow. So it's 9,900. Okay, then now our total taxation paid is, okay, let's just quickly calculate, is 415,300. So that's 415,300. Okay, and you need to indicate it's an outflow. Then 2.4.2 says we need to calculate the proceeds from the sale of fixed assets. Okay, sale of fixed assets, the information that relates to the sale is information D. So they're telling us that the total cost for acquisition of a new vehicle and extensions to the building during the year amounted to 1,702,000. And then during the year, equipment was sold at carrying value. Okay, so let's determine what our proceeds were there, because we are dealing with cash flows and we know that it was sold at carrying value. So we need to actually determine the carrying value of that asset, okay, which is the equipment. So on our fixed assets at carrying value, we're given here the closing balance and we're given the opening balance of 9,890,600. So our calculation would start with 11,434,000. Okay, so we got to 11,434,000, okay, as at the end, whereby we would have added the 9 million. It's 9,890,600. Okay, so it's 9,680,600. Okay, let's just ensure it's the correct amount. What's actually 890? Okay, made a mistake there. So this is 890. Now we know that we have added equipment worth 1,702,000 with buildings and vehicles, etc. So it's 1,702,000. Okay, you would add, okay, plus 1,702,000, right? But now, then what we are going to look at is depreciation also, because you know that to calculate the carrying amount, you need to have depreciation of 190,900. Don't forget about that. Then we're going to decrease that by depreciation of so I've forgotten the amount already. So the depreciation amount is 190,900. Okay, so minus depreciation of 190,900, and then what you would have done also is make a sale of X. Okay, because you've made the sale of X, that's the carrying value of the equipment that was sold. So in this case, you then solve for X. So it's 11,434 minus 9,890,600 minus 1,702, 100, and then plus 190,900. And then that should give you X being equal to 32,300. So that's 32,300, and it's an inflow because we have received these proceeds from the sale of the fixed asset. Okay, so the last one that we're going to look at is the net change in cash and cash equivalents. Okay, now we're looking at our cash and cash equivalents, which is usually under our current assets. Okay, so we're looking at our cash and cash equivalents here, which is 7,800 for the current year. And also our bank overdraft affects our cash and cash equivalents or our bank account, which is 319,000. Okay, so in this case, we are going to first determine what we had at the end, which is at the end of this year. We know that we had 7,800, which is a positive, minus the 319,000 bank overdraft that we had. So we're going to take those two and subtract. Then we have a change or balance of 311,200, which is negative. So we had a negative we had negative cash and cash equivalents, and then the cash balance at the beginning we are given. Okay, let's look at what we're given here. So for the cash and cash equivalents at the start, we had 85,000, but on our bank overdraft we only had zero, so we had 85,300. Okay, so that's 85,300, and then you just determine the difference between these two, and so that is 311,200 plus 85,300, which is 96,500. Okay, so that's a net change in cash and cash equivalent. So the reason I added these two, think about this. I had a positive balance, right? I had a positive balance, but now at the end I have a negative balance, which means I should have used more. Okay, those brackets are needed there because it's negative change. So my balance was from 85,300. So at first I would have consumed the whole 85,300 until I got to zero. And then now I needed to get to 311,200. So I would have consumed something that is worth 85,300 plus 311,200 to get a total negative balance of 396,500, which is the total change. Okay. So that is it for the question 2, and I hope that was really useful. Please don't forget to subscribe, share, drop a comment, and share with friends and family who might need help with accounting. Other than that, I'll definitely see you in the next video. Cheers.